What's going on, everybody? How are you? This is Lawrence, of course. Financial Thing Thursday evening or afternoon or morning, depending where you are. Maybe Friday. Welcome. We have a special guest today on the screen. George Huntley, CEO of the Money Platform, a United Kingdom peer-to-peer lending company. We're going to find out all about the Money Platform and what they're up to. Please go ahead and hit that thumbs up if you can. Really helps out the stream. Lets YouTube know that you guys like this stream and that you're watching it. There's the real star of the show in the background. So let me, without further ado, I'll do a little announcement at the end. So hang out to the end. I have a good announcement for you coming up. So let me go ahead and get Mr. George Huntley in here for you. If you have any questions, put them in the comments. If you want to know anything about the Money Platform, put them in the comments, and I will ask George to answer them. So let's get George here. 1 second. Hello, George.
Hi, Lawrence.
All right, let me bring you onto the stream. We have people waiting to see what you have to say today. I'm sure many good things.
Very exciting.
There he is, the man himself, George Huntley, CEO of the Money Platform. Hopefully you can see his, I think your name is just a little bit off the screen, but I'll fix that. But first of all, thank you for doing the stream today. We appreciate it. Hope you enjoy
very pleased to be here. Thanks for having me, Lawrence.
Yeah, absolutely.
I'm appreciating it. Is that a dog you've got in the background?
That is a little. Where is she? She's somewhere hiding off. I always have to remember it's in reverse. But I don't know if you can see. She's maybe cut off, but yeah, she's hanging out in the dog basket. She's the real star of this show. To be honest, certainly not me. But yeah, do you have a dog?
No,
okay.
I don't. My parents have a dog. They've got a Cocker Spaniel, which is much more active, I think, than your dog looks very peaceful. My parents' dog would be running around, jumping up on everyone right now.
She is pretty peaceful for a dog. Sometimes she has her moments, but she's getting up to be 6, so she's calming down over the puppy. She still likes to play, but anyway, we're not here to talk about dogs. We're here to talk about peer-to-peer lending and the Money Platform. So we're going to get right into it. We got people watching. If any of you out there have questions for George, feel free, put them in the comments. We'll do Q&A as we go along, I think. We'll probably just do it. We'll pop some questions up on the screen as we go along if you have them. And so tell me, George, you look like a young guy, I have to say. I don't know how old you are, but you got a very young...
I'm 30, so I think I'm ceasing to be that young. But,
still look young.
Gone over the line.
Tell me about within your 30 years, what is your background as far as how did you come to become the CEO of the Money Platform? What did you do before that?
Sure. So yeah, I started off after I graduated from university. I started off working in asset management and corporate finance. So I did that for a few years and really working kind of in the FIG space, so financial institutions, listing those on the stock market and doing some M&A deals around that as well. And then I got a bit worn down by the kind of slightly relentless hours that you have to do in that sector, and decided that I wanted to do something a bit more creative. So I decided I wanted to kind of be involved in a startup, and I'd actually started lending a little bit in P2P, and I saw it as a really exciting space to get into. So I guess in 2016, started getting involved at the Money Platform.
What did you? Let me ask you. So you said you did some lending. Do you care
Yeah.
to say what your experience was like, who you lent money with, or was it a
Yeah,
good
no,
experience?
sure.
Yeah.
It's a kind of hall of disaster. I was going to say hall of fame, hall of disaster. Um, I mean, none of them have gone too badly wrong, but Rate Setter was, I think, the first one I got involved in, which obviously is closed. They're all closed, basically. So Rate Setter was the first one, then as kind of gateway drug, and then Funding Circle, Lending Works, which those accounts are all winding down now. Then I got involved in another one, a property P2P one. I can't remember what it's called.
Funding Secure.
Funding Secure. That's the one.
There you go.
Which has been a real disaster. Actually, that's the worst of the lot. And I've also lent on Axia Funder, which was actually very good. No beef there. But yeah, so it's had its ups and it's had its downs. And I'm still still invested in the P2P space well, certainly at the money platform I am. And then I recently also tried to deposit some of my withdrawals from, I think it was Funding Circle, into another P2P platform, which again, the name has escaped me, maybe Fund Ourselves. And yeah, so I've dabbled across lots of different platforms. I think I've avoided some of the worst disasters in the space, but certainly it's been like a bit of a torrid time over the last couple of years for sure.
A bit of a mixed bag. Yeah, somebody too, I don't know if this is your camera, but somebody mentioned your lens was a little fuzzy. It's not the end of the world. We can still make out who you are, but don't worry about it. It's sometimes cameras on laptops can be a little funny, but don't worry too much about it. So you had this experience, and then you thought, I'm going to be a glutton for punishment and start off my own. Oh, there you go. That's a little bit.
That makes a bit better.
Yeah. You said, I'm going to be a glutton for punishment and start my own peer-to-peer company. How did that come to happen?
So actually what happened is I joined the money platform actually as the first that was founded by a guy called Charles Balcom, and he founded it in 2016. He wanted to hire someone who had kind of general kind of generally help it out, and had some kind of financial background. He had actually worked in a property space before, but kind of bizarrely decided to set up a consumer credit P2P lending company, having had no experience in the financial services space. So I got involved at that point, and then Paul Charles had a lot of back problems, and actually had to step back from the company because of his back problems. So he stepped back fully over a number of years, kind of stepped back. I didn't stab him in the back or anything like that. He certainly had very bad back problems. He's still involved as a non-executive director, and he's a major shareholder in the company. But he's actually decided subsequently, in light of the surgery that he's had to go through, to set up an app which is called Pained, which he's just starting. I think he started it last year, and he's just getting launched now. And it's kind of aiming to help people who are going through pain to manage pain without having to go to surgery. So that's a real passion project of his, and he's decided to kind of step back from the money platform and focus on that.
Okay, so you kind of came in as a almost like an employee, or?
Yeah, I think I was COO. I mean, I obviously with a significant shareholding as well, but yeah, came in as COO and have been kind of involved in pretty much every bit of the business actually, from the get-go.
How many people are over there working with you at the money platform, George?
Sure. So we're really small still. There's 10 of us. I think we've hired 3 people this year. Got another open hire role currently out there in case anyone listening wants to apply. But
What are you
Probably
looking
not, because
for?
I think we're looking for a customer services person. So I imagine that's not the marginal person who listens
I don't know. We've got some
to this.
people that watch the stream who have amazing customer service skills. I'm telling you. So if anybody out there watching who wants to work for the money platform, drop George a line. But you never know, right? You never know.
You
So
never know. You never know.
and
Yeah, I've got to tell everyone about it. And so yeah, we've got 10 people, and one more open hire, and I guess we'll be looking to add a few more to the team in 2023.
I actually I like companies that are small. I have to tell you, I don't think it's necessarily a good thing that a company has 50 or 100 employees. I think it's a lot to manage. The expenses can be astronomical, especially if you're working in the city of London. So we've seen some of these big peer-to-peer lending companies that have had several challenges because of having such big, large staffing situations going on. So I kind of like that. But
My mantra as well, I think, is always like, yeah, I mean, if we can try and automate anything, we should try and automate it before we have to hire someone to do something. So that's certainly the view that we've taken. It's interesting. Yeah, I spoke to a credit union, someone who runs a credit union, who has a much smaller number of customers than we have, but they've got 50 employees or something.
yeah. When you say
Like
credit
crazy.
union, you're talking about in the UK or?
Yeah, in the UK. So it's a kind of, it's a company really that people uh, borrow from, but I think you can also deposit your money in, but it's not in return for interest. It's a kind of a concept that I think is popular in Scandinavia and places like that, but I'm trying to kind of import into the UK over many years.
That's cool. Yeah, they have them here in the US, credit unions. But so tell me, you guys are offering, like consumer credit loans type loans, right? And there are other companies in the peer-to-peer space that do that. Not a ton, but there are a few. So tell me
Fewer and fewer, I would say. Yeah,
fewer and
fewer and
fewer.
fewer.
Yeah, what does the money platform offer that would make borrowers and lenders come to you guys versus other companies that are
Yeah,
doing the same thing?
sure. So yeah, I mean, just yeah, to introduce ourselves, I guess we're focused in the high cost short term space. And we were, I think, the first P2P platform in that space. The goal of the business, I guess, is to deliver really good returns to lenders, but also to drive down interest rates for borrowers. So why someone would come to us? I'll start just with on the borrower side. What we've really pioneered is using open banking, which is when you can kind of go securely into someone's bank account and see the information that's there. And we've pioneered a kind of a credit score based off that open banking data. And we really like that because it gives a borrower who maybe has an impaired credit history or a limited credit history, maybe they're like a recent migrant to the UK, it gives them an ability to get credit that they probably otherwise would be excluded from. So really good for borrowers who are excluded from mainstream finance, and would get rejected from pretty much every other lending company. And I can tell you, even like payday lenders will reject 95%, 90 to 90% of the people who apply to them. So there's a huge number of people out there who are rejected based on their credit score, credit history, or lack thereof, more often than not. The other reason they might come to us, but I think this is probably more a benefit for the lenders actually, although it is a benefit for the borrowers too, is that we help coach our borrowers. We provide a bunch of resources that help borrowers to improve their money management and point them in the direction of resources that would actually help them not require this type of product or a short-term loan in the future. So we take someone who is a subprime customer, poor credit risk, wouldn't get a prime credit facility, and we try and turn them out at the other end, someone who might get that prime credit product. And to that end, actually, we're launching a new longer, larger loan product. next month, which will have it'll be a 12-month installment loan at lower APRs, and that's because we don't want to just shove the customers out the other end. We want to actually be able to kind of keep them on as long-term customers. But from a peer-to-peer side of things, so from a lender side of things, I guess we're a slightly different proposition to a lot of the other platforms. So we don't have a provision fund, we don't have a secondary market, we don't have an IFA. So we're not really at that kind of more retail end of the spectrum, but we do have quite good returns. So I don't know if you had a chance to look at our outcome statement for the last year, but our kind of gross returns, that's after our fees, and after defaults that have been realized and any non-payments to this point is I think 13% for last year. We're expecting it to be around the same for the coming year as well. Yeah, 13.1% so far for 2021 to 22, and we're expecting it to be 13.4% for 23-24. And then actually in the COVID year it was super good for lots of reasons, but it was 59%. So it was amazing. Obviously, we're not expecting that to continue. COVID was obviously a very unusual time, and we had a lot of government intervention, which helped a lot of people, and there was this kind of on-off period. But those are the gross returns. Now, on top of that, we have a kind of calculation on what that might translate to as a lender. So we take off cash drag, we take off tax, which a lot of other platforms don't do, incidentally. So they give this kind of unrealistic gross picture, and then lenders end up getting a lower return and being like, what's going on here? But cash drag is a feature of our product because funds aren't always lent out. So yeah, returns is a big part of the draw for lenders. And I suppose another unique feature is that we've got a one-to-one relationship. So one lender lending to one borrower. Now, again, that's not great if you're looking to lend like 500 quid or £1,000, but a lot of our lenders are lending at significant scale. So we've got a lot of lenders lending, 50 grand, 100 grand. And when they're doing that, when they're lending over 500 loans or whatever, that's, I guess, who we built the platform for currently. We might change that. That's who it's built for right now. And that means that they're able to get that really good diversification. But it also means that from a lender's point of view, you've got that kind of admin trail through what's happened to each loan, which you don't necessarily see if you're lending with, well, from my point of view, if you're lending with like Lending Works or Rate Setter, you never really saw the underlying assets. So it's a bit of a black box. With us, it's fully transparent. You can see every single loan. And that's actually one of the things I really liked about funding Circle back in the day, was that you could see the individual loans. And I think originally you could actually pick out the individual loans you're lending into. And that was really cool. And also, I guess it kind of harks back to Zopa right at the beginning, where you could like very much see, it was John from Bristol that you were lending to when he was building a conservatory or whatever John from Bristol might be doing. So yeah, that's kind of what our product is, and why we think it's good for lenders and borrowers. Oh, I've lost you, Lawrence.
Oh, sorry, there we go. I was muted for some reason. I was saying John is in Bristol. I hope he's enjoying that conservatory. I'm sure he's watching out there. Tell me, when did George, the money platform, offer its first loan? How long have you guys been doing this for?
So I think it was 2017, early 2017. And we kind of, for the first year and a bit, we would very much testing our credit decision engine. I would say, hands held up, like our credit decision engine has changed quite a lot since then, and it was a tricky time because we were using very little data, very limited data to make lending decisions on. We didn't have, we've now, I think, made about 40 million lending decisions. We're often seeing the same customer come through multiple times, so it's not that there's 40 million people applying for our product out there, but we've made so many lending decisions that we're able to kind of stack that data up and make better decisions. Whereas, I guess in the past, when we first started out, we didn't have that depth of data and history that we've got now.
Is that because of the open banking? Is that kind of a new thing that you've been using to get that information?
Yeah, for sure. So open banking, I think we started with that in early 2020, which was actually super helpful with COVID because you got to see if someone's income was coming in. It's like absolutely critical in our space to be able to have that kind of proper level of income verification, and really see their affordability very clearly. Particularly, that's really helpful right now as well, I would say, with the cost of living crisis.
Yeah.
But yeah, I mean, 2020 returns were really good. But actually, I would say from mid 2018 onwards, we started, we'd accumulated quite a lot of data from our lending in 2017, early 2018, and we started making basically better decisions, and things have been kind of improving since then. I think we've just slowly been kind of adding new rules in. We have a weekly meeting where we analyze, our lending performance, and look at each rule within our kind of armory of rules and tweak them. So yeah, I mean, slowly but surely we're making better lending decisions and accumulating more data to validate that.
That was actually one of the questions that Darren in Cambridge had asked, and I popped up on the screen. It says, what credit checks do you run on borrowers? What is your basic criteria to consider somebody creditworthy for a loan? So you already mentioned the open banking. I presume,
sure. So,
do you have like a basic credit score that you look for?
Yeah,
what is
yeah.
it?
So there's various different things that we use, and it kind of depends on where the customers come from, in terms of which channel they've come from, which source they've come from a marketing point of view, because we found some sources work way better than others. But yeah, we've got open banking, we've got Equifax, we've got TransUnion, we've got our own internal scoring based on how they interact with our website. So we've got loads of different things. I mean, one of the Equifax, we use one of their main scores within the space in which we operate, and we've got a cutoff point there where we don't look at anyone below that score. So that's something that we use quite a bit. That's a driver for decisions. But we've also got our own internal scoring, which we use. We kind of see how they interact with the website, see what source they've come from, and we've got some cutoffs there. And we also integrate that score with other scores from mainly from Equifax, actually. So yeah, we think that's actually slightly better for our customers than Equifax's scoring. So yeah, I mean, we're actually plugged into all three of the bureaus because we use Experian's open banking products. So Experian, TransUnion, and Equifax.
Okay.
We get data from all of them. A lot of lenders just use one of them. We want to build the best credit decision engine that there is in this space. So
okay.
we thought we'd get all three.
Why not?
Yeah, well, there are costs associated with that, but
yeah, do you have to pay for each pull of that credit data, or how does that work?
Yeah, you do. So yeah, you've got to pay each time you get a credit file from someone. We've got some kind of neatly structured deals, which work quite well for us.
Okay.
So.
That's good to know. So tell me, what is the minimum, just some basic stuff for people out there? What is the minimum amount that somebody can lend through money platform just to get started and test the waters out?
Sure. I mean, the very minimum is 250 quid.
Mm-hmm.
But that would mean you were lending to literally one person.
Okay.
So that would be a risky thing to do. We have had people do it. Sometimes it works out great, and the loan repays, and I mean that happens 85% of the time. The loan repays, so it does often work out really well. But I think most of our liquidity, most of our lenders are lending at a much larger scale than that. So, I think we tend to say for 10 grand you can get a pretty well diversified portfolio, because you can lend, I think, 40 times, so you can get a portfolio of 40 loans for 10 grand. But I suppose if you were lending for a year, if you put, our longest product is 3 months, right? So if you're lending for a year and you put three grand on, or 2.5 grand on, then you would get that 40 loans if you were lending for the full year, assuming they all repaid, I suppose. But which they won't. But yeah, so I suppose you can lend from 250 quid, but it's the lender's job to diversify themselves. We're not trying to be rate setter. We don't have a provision fund. I think the FCA takes a pretty doesn't like provision funds at all, really. So we haven't gone down that route, and I suppose we are moving into a world where most P2P lenders are sophisticated or high net worth investors. Love it or hate it, that does seem to be where the regulator is moving with their latest set of regulations. And so there hasn't been much pressure on us. I think when the company was first launched, there was an idea that we might build, that we're going to start off with this, and then we're going to build a kind of mass market product with a provision fund and all that kind of stuff. But actually that hasn't materialized, and the reason for that is because the regulator's really clamping down on non-high net worth investors getting involved. I think it's a shame, to be honest. I think it's a real shame. It means that platforms are often just kind of professional investment companies to get money to lend out, which means that the man on the street's excluded, and I think that's an absolute tragedy. But running a business, you've got to be pragmatic, got to be making sure that we're in the regulator's good books. And so we've always focused on the kind of more high net worth and sophisticated end of the market rather than the retail end. So, I would say to anyone listening to this, you can invest from 250 quid, but you want to make sure you're diversified enough so that any one default won't negatively impact your portfolio.
Okay.
And that's just worth bearing in mind.
Now, do you, as a lender, do you pick out the loans yourself? If you're doing, so you put a couple of 3,000 on there, are you picking those loans yourself out?
So what you do is you select buckets. So you select we've got 4 basic products right now, and that's going to change when we launch this new larger loan next month. But currently we've got four buckets. So we've got a £250 loan, a £500 loan, £750 loan, and a £1,000 loan. And you choose one of those buckets, and there's various durations that we offer there. And you just select, and then you'll just get whacked in the queue, and you'll just get queued to the next borrower who comes through for one of those products. So yeah, that's pretty much how it works. Okay.
And so you mentioned about the outcome statement that the returns have been about 13%. That was for the last year? Now, did you mention that was a net after you take out the cash drag estimation or was that a gross amount?
So that's gross. Mm-hmm. It's after our fees. Okay. So we charge 50% of the interest, and it's after any losses. So that's a return that is kind of crystallized right now in a sense. So it will go up. So that 13.1% for 2021-22, as we get payments back from defaulted loans that have entered repayment arrangements or plans or whatever it is, that 13.1% will slowly trickle up. Okay. But it's so it's gonna slowly go up from there. But no, when we wrote our outcome statement, we estimated cash drag would be 25 to 35%. So, mm-hmm. If you deposited 10 grand, for example, you'd have about 2.5 to 3.5 grand sitting at any one time on the platform unlent, okay. On average. Right now, that is lower. is quite a bit lower than that. And the reason for that, I think, is just because the amount of demand in the market for this product right now is very, very, very high. So we're accepting far fewer customers because we can't keep up with the demand. So we're accepting about a lot fewer customers, like 60% fewer customers. And I also think, some lenders, I think there's less flow in of lenders because of some of the challenges that have been in the industry over the last couple of years. We've doubled our volumes over the last years, but I don't think the number of lenders in the P2P space has doubled. I think probably, if anything, it's actually gone down because of all the bad headlines and all the platforms that have kind of failed their customers. So yeah, I mean, we're struggling to keep up with our own growth and with the growth of the industry that we serve. So cash drag right now is much less than 25%.
Okay.
It would be kind of 5%, I would say, max right now.
Yeah.
But yeah, that's what we've. So if anyone visits our outcome statement, we've predicated how we've got from the gross return to the net return is just taking off 40% tax, which we assume is most people's tax rate who are lending, and then taking off 25 to 35% cash drag.
Okay. And then also for anybody watching out there, if you do want to take a look at the outcome statement, it is, if you go to the main money platform website and you click on, because it is, I did find this, George, a little tricky to find. I have to say this was one thing that I did want to mention to you.
Are you a registered lender, Lawrence?
I am a registered lender too, yes.
Okay.
I am registered.
It's yeah. I mean, we should probably make it easier to find.
Yeah,
I agree.
but if you go to
if
the
you're
main,
a registered lender,
yeah,
it's just on the right hand side as you log in underneath your name.
If you're not a registered lender and you want to go check it out before you sign up, if you go to the I want to lend page right under this green box, there is a link here that says please read our restatement and outcomes statement. So I know I was looking for it before I signed up. It was a little tricky to find, but it is there. So for anybody that wants to go look at it, you can see all the statistics here to do that. I was going to ask you, what is the current size, George, of the loan book approximately at the moment? Sure.
Yeah. I mean, so as a kind of 3-month duration product, loan book, I guess, is something that we don't. It's not a KPI that we work to because obviously it's very short loan book, so it's recycling. So we lend just under £1 million a month. So I guess, given that our product, I think the average loan is just under that 3-month period.
Yeah, you have very short loan durations, right? That
so it's less than 3 million, right? So it sounds absolutely tiny.
Yeah.
But as a business, that produces about £150,000 of revenue. So it's I think probably if you ranked us in terms of P2P lenders on Loanbook, we'd probably be one of the smallest, if not the smallest. But we've been profitable this year, and we're generating decent revenues off that. Just because our loans are turning over a lot. So, and that's a real benefit, actually. Sorry, I forgot to mention that from a lender point of view, we have liquidity. Like our typical loan is 3 months long, so you don't need a secondary market to exit. You just have to wait 3 months, and your loan should have repaid. And if it hasn't repaid, then you can. Well, it will possibly default and you'll get the tax relief, or it might enter a repayment plan and you might also get the tax relief. But yeah, I mean, it's a short-term product, which is a massive benefit for lenders. I forgot to mention that. I mean, I'm stuck in some of these really, really long duration loans with Funding Circle, and it's going to take me ages to get the money back. And it's really frustrating not having that closure, and I know a lot of other lenders feel like that as well. It's really nice having a short duration product which completes quickly.
Okay. Good information, George. Several people in the chat are asking about the kind of ugly duckling of peer-to-peer lending, which is the default rates. What, on average, are statistically the types of default rates that somebody could expect to be facing if lending through the money platform?
Sure. So our default rate for last year, I'm just looking at our outcome statement just to check I'm not reading it wrong. But our default rate for last year was 7%, and we're expecting it to be the same for this year. It's actually slightly higher than we forecast last year. So we forecast 6.5%. By default, what we split our bad loans into two categories, right? There's defaults and then there's delinquencies. Delinquencies we expect will repay in full eventually. You can still claim the tax relief off those as well, and then when they repay, it gets treated as interest. Defaults are when we do not expect any money back from those, like they've done a runner, goodbye. And those so 7% of loans we expect to default. And on top of that, then there's 10.5%, which we've had to restructure those loans. Some of those will repay. Okay, they won't repay in the first 3 months, but they might repay on the 4th month or the 5th month. So they might have just pushed back their payments by a month or something like that, which we see a lot of, particularly since the start of COVID. I think there's a lot more awareness of forbearance and the rights that consumers have to get their payments pushed back. So that kind of gives a total of 17.5%. So 17.5% of customers will require some kind of intervention from our part. So they which is actually from our point of view in our industry pretty good. I think in the high cost short term space, pre the 2016 regulations, which really put a ceiling on the amount you could charge and did lots of things. The average high cost short term lender was lending at a 15% default rate. So we've essentially halved that, and then there's that 10% of delinquencies on top. But yeah, as I say, comparing that to 2015, 2014, they were looking at 15% defaults and then 25% delinquencies, and they would make lots of money on the delinquencies because they would charge lots of late fees. That's all been capped now, so we don't want anyone to default. We don't want anyone to go delinquent. We want everyone to repay on time. But obviously, these things do happen, and we're obliged to work with the borrower to find a solution that works for them.
What is the recourse as far as if a person stops paying and does a runner? I'm imagining they're very difficult to recoup that money from. What do you do to try to get that money back if somebody does that?
Sure. Yeah. So this is to be really clear with everyone listening, this is unsecured consumer credit, and lots of lenders who I've spoken to have kind of old-fashioned ideas about what we can do. We certainly can't go and seize people's property or anything like this. It really is unsecured. So the main things that you can do are you can take them to court and get a CCJ. We don't do that because it doesn't work. In summary, it doesn't. If the person's not going to repay after you've sent them a default notice, they're no more likely to pay once you've defaulted them in the court. So it doesn't work. It costs a lot of money, and it doesn't work. What we do is we mark their credit report as defaulted, and it's worth stating very clearly they don't have that when they apply to us. So none of these people are defaulted. We never would accept someone who's got either a CCJ or a default on their credit file, because it shows that they they've got no real intention of repaying if they haven't cleared up their credit file by the time they apply to us to that extent. I mean, there are people who have maybe had credit problems in the past, but someone who's got a default or a CCJ, they're not worth lending to. We don't lend to them. So we can default their credit file, and that does have quite a big impact because that will stop them being able to rent a house, get a mortgage, get a phone contract, do loads of stuff. So we do see people who we actually defaulted maybe 2 years ago who now are getting in touch saying, actually, I just want to get this cleared so that my credit file gets cleared up. And that's really interesting to see. But yeah, I mean, that is pretty much it. So we can call them up and send them emails, texts, do all the standard collections things. We've got an external collections agency that we have worked with, but we can't seize any property. These are not secured assets, and that's worth everyone just knowing about before investing with us. And I think that's actually on one of the questions that you fill in when you sign up as a lender, just so everyone knows about that. I mean, I suppose on the plus side, you pay for security, right? So I don't think you get that many secured asset returns with a kind of 13.1% return and growing, because that 13.1% is where it is now. We'll get repayments on that, so it should get up higher over time. I think that was down at 8 or 9% a couple of months ago. So that's going up. So yeah, I think you take high risk and you get higher reward, I guess.
Yeah, and you do what you can as a company.
I mean, we're fully incentivized to get people to repay because we only get paid. We're not like I think if it was Funding Secure, who I used to lend with, I think they took a fee as soon as they sent the money to the customer. Yeah. So they didn't actually care if the money got repaid at all. Like they had already got paid. Whereas for us, like we get paid half the interest, the lender gets paid half the interest. We only get paid when the lender gets paid. So
good incentive.
Also, I'm incentivized on the lending side too. So we really want default rates to be as low as possible.
Okay. Elvis P, who has a very nice picture of Elvis Presley on here, says one lender to one borrower, right? And I think you already said that if you invest a minimum, whatever you invest, a minimum of $250 goes into a single loan. So in order to diversify correctly, you want to have enough money on the platform to be able to take several loans. So I think we already covered that one, Elvis.
That's correct. I mean, we have had people. There is a guy. I don't know if he listens to your podcast. He deposited, I think, £1,000 and lent it into one £1,000 loan, and that loan repaid. He then invested in another one, and that repaid. And then the whole thing has been going on for about 3 or 4 years now, and he's I think he's maybe had one default a bit because the interest is so high, and because he's had a very low proportion of defaults, largely through being lucky, frankly. He's ended up with like a multiple of what he initially invested. So these are kind of, this is kind of equity market levels of risk, and I suppose equity market levels of return, probably slightly lower than equity market levels of risk, actually, because it's a debt asset. So we very rarely see people lose money who have got a diversified portfolio. I mean, it's hard to do. Okay.
So you've talked about your lending experience with a company like Funding Secure. Some of us have been involved in multiple companies that have gone up the Swanee. So what would you say to people watching who want to invest in peer-to-peer lending, how they can safely look for a reputable peer-to-peer lending company, as somebody that may be kind of green or a beginner? How do they pick out where to invest the money that's going to give them a good chance of that company not going under and doing what Funding Secure did?
Yeah, I mean, it's a tricky question. I think part of it actually comes back to what I was just saying about how is the platform incentivized? Because when you get a platform that is paid an upfront fee for issuing a loan, they don't care that much about what happens to the loan after the event. You've also seen some bad directors. I think that it's pretty hard to find out who's a bad director of a company. You know, I've seen some like real shocking stories about directors kind of taking loans and then anyway. But yeah, I mean, I did have a little think about this. I mean, I think and this is, you know, this is not financial advice, just to caveat this is just my musings, having invested over a number of different platforms over the years. But you know, spread your investments. I wouldn't put it all in one platform. I spoke to a lender a few months ago who had put all of their money in one platform, and I think that's a bad idea. I would invest it in multiple different platforms. I would also just test the liquidity of the platforms you're using. I've been kind of surprised by some of the illiquidity of some of the platforms I've seen. So like actually one of the ones I mentioned, which I didn't mention, but I do lend with and have lent with. I'm actually winding that one down because I've been disappointed with it, but it's Bondora. And as soon as I started like taking money out, I realized it's pretty hard to take money out, and the returns seem to be not quite as good as it looked initially. So you know, it was saying 15% return, and then it suddenly became about 5%. Well, not suddenly, but over a period of time. So test the liquidity, see if you can get your money out. And also, I think to that end, be slightly nervous of secondary markets, because they can close. So don't let that be, and don't let that. And also, actually, Lawrence, the other thing I would be nervous of is provision funds, because they're going to change. But that they can also bankrupt P2P platforms, and that can, if a P2P platform goes bust, that has quite big implications for the ability for you to get your money out and for you to get your loans chased. Every P2P platform now has to have a wind down plan, which is a very good thing, and gives a lot of security to P2P investors, and it's really great. I don't think that many P2P lenders know about these wind down plans, but it means that they've put money into a special account to help you get your money back. If the platform goes bust, there'll be people employed to chase up your loans. But you know, be nervous of those secondary markets and be nervous of those provision funds, because in my experience, they haven't always been quite as good as they said they were. And yeah, I think those would be my top tips. You know, but beware things that sound too good to be true. Spread your investments, test the liquidity. I mean, if you can do a bit of DD on the platform and whether it's right for you, and stuff like us, like, you know, if you're someone who's got £1,000 of savings, this is not, you know, the money platform is not the right place for you to invest.
Yeah.
But maybe it will be one day, you know. But right now it's not. So you know, it's DD and finding out what's right for you.
Yeah, great tips, George. Great tips. Stephen Hales asked, does the money platform invest in the loans themselves? Do you guys invest in your own loans?
Yeah. So P2P so the company itself cannot invest in the loans itself, because we have done some EIS, Enterprise Investment Scheme, capital raises, and to be able to do those, you can't be a lending company, so you can't have any debt. So we can't do that. I mean, as employees in the company, yes, we do. And yeah, so yeah.
You just can't as a company.
My wife does as well. Actually, she deposited some just yesterday, in fact. So yeah, I mean, we do as employees, but just the company itself can't.
Got it.
Yeah.
Okay. Cool. Let's see if there's any other interesting questions. George, so what's the one single biggest challenge that you have faced being the CEO of the money platform? Because I know it can't be easy, right? I mean, you're trying to run a finance company, a lending company. You have your challenges. What's the number one?
Yeah, and
biggest
particularly
one?
when it's a small company and you're wearing many different hats. I mean, I think. Oh, the one. Okay. Let me give you a borrower one, and then let me give you a lender one.
Okay.
I think the borrower one is getting borrowers cheaply is really hard. You know, we've got, I think on average we make about £70 or £80 per loan that we issue, and we have fixed credit bureau costs and fixed marketing costs. So trying to get those marketing costs cheaper so that we can make a margin and make the profit. That's really hard, and we've done that now, and we've been profitable this year, which is great. But that's been kind of years of tinkering. And then on the lender side, I think the tricky thing is really just trying to educate our lenders, and that sounds probably a little bit kind of patronizing, but making sure that our lenders are the right lenders for us, so making sure that they know the risks. And you know, I have I remember when I first started work, I was working for a kind of asset management company, and the founder of that company, we invited the graduates to have lunch with him, and he said, you know, you're doing this is what we do at this company, is we're looking after people's livelihoods here. We're looking after their money, and their money means their livelihoods and their expectations and their hopes, dreams, and fears. And that is kind of what we're doing as well. So it's a responsibility I take very seriously. But with that comes the challenge of making sure that our lenders know what they're getting in for and understand the products. Which is why I'm being very cautious by saying you shouldn't invest unless you can get yourself diversified.
Yeah, I think that's a great point, everybody. I think most of the people that watch this stream tend to be pretty up on risk levels, but it's always something for anybody new out there, just understand that you can lose your money investing in peer-to-peer lending. There is no guarantees in this investing, so important to understand. See, we've been going for about an hour. I don't want to keep you too long because I know it's getting late, so I'm going to run through quickly just a couple of other questions. If you can just fire off answers, and then I can let you go back up the river to where you said you live up the river. So
I live up the river.
Back up the river in London town. So let's go through this real quick. Alan Stratford says, George, approximately how long does it take to get cash deployed once you put money in?
I mean, it would take like a day. Right now, it depends how much you're putting in, but yeah, I mean, it's very quick right now because we've got a lot of customers looking for loans, and so very quick.
Unless, Alan, you're putting in 10 million, then it might be more challenging. But
I mean, if you're putting in 50 grand, then it will take a week. But if you're putting in, you know, 5 grand, it will take a day.
Alan's a high roller. I mean, this guy, he might be sitting on tens of millions. We don't know. So, but realistically, pretty quickly for most of us. You mentioned about the profitability of the money platform. You said you have been profitable. Darren asked, is the money platform profitable business? You said yes, you are profitable. How long has it been running in profit for approximately? Have you been
just since January this year? So yeah.
Okay. So big achievement.
You know, it's been we went from, I think at one point we were burning 70 grand a month or something a few years ago, and that's been just slowly coming down, and then from January onwards we've been profitable and kind of becoming more and more so, hopefully.
Okay. Elvis has asked, does the money platform have a plan? Should it cease trading? Yes, every peer-to-peer lending platform via the FCA has to have a plan, generally third-party trustee to handle the loans, or what do you have in place?
So we've got a wind-down plan. It has to get approved by the FCA. It's part of some regulations, which you can look up, called I think it's called 19/14 FCA regulations. And one of them is to have a wind down plan, got approved by the FCA, and it means that we've got to put a chunk of cash into a segregated bank account, which is used to pay wind down costs. So that's like paying of people who are kind of servicing the loans and making sure that they repay and doing stuff like that. I mean, fortunately for us, our loans are quite short, so the costs aren't that high. But for longer duration platforms, I don't know, but I imagine they've had to put quite a lot of money into a separate bank account.
Okay. And then let's see if there's anything else interesting here. Everybody says thank you for coming here and doing this, by the way.
Thank you
So
for listening.
You got some.
Yeah, and if any of them, if any of you guys are in London, we're going to have a lender event, and it's going to be, we didn't have any before COVID, and I guess COVID, a lot of people were obviously very nervous of going out during COVID, so we didn't have one for the last couple of years. But we're going to have a lender event next October, so if anyone would like to join and meet the team, then send me an email, which I'm sure, Lawrence, you can. Well, my email is george@themoneyplatform.com.
So easy.
So easy, yeah.
So easy to remember. george@themoneyplatform.com. One other question that I think is a good question here is Alan again says, do you expect the current economic environment to adversely impact returns? I mean, I would think during bad economic times, you're kind of a place where people come to grab money when they need it, right? Because that's the way I see the economic environment going.
So yeah, I mean, it's hard to know. I'm quite cautious by nature, so we are, we're ready for that in a couple of ways. We've done a couple of things which it's worth letting people know about. So firstly, our scores, our minimum score thresholds. I talked about the scores earlier and what scores we have. They're higher than they've ever been for customers. So as I said, I think we've cut the bottom 60% of customers that are coming through to us. And we've done that mainly through excluding lower scoring customers. Secondly, we've changed our affordability criteria to add in a kind of premium for the energy price hikes and for the cost of living crisis, and that's cut even more customers. I mean, that's less predictive. Affordability seems less predictive of bad debt performance, but the scores are very, very predictive. So I think we've certainly done more than enough to counteract that. But yeah, I mean, obviously there's always a risk that things will be worse than we're thinking. But I think we've done more than enough, to be honest.
Yeah.
And also, actually, one of the things we're seeing, Lawrence, which is worth saying, is we're seeing more high quality customers come to us to start with. And I think that's for a couple of reasons. Firstly, mainstream finance is getting scared of kind of short-term debt, even though it's actually really helpful for people. So overdraft, the number of people qualifying for overdrafts has gone down massively. But also, I think, more and more people are having, difficulties like paying their energy bills and stuff like this. So there's more and more people needing not like a 10 grand loan, but just needing a little bit to tie them over for a few months. So yeah, we're seeing a higher quality of customer coming through, which is great, to be honest.
Yeah, that's good for everybody. Okay, well, we've been going an hour and 3 minutes, George. I'm going to say thank you so much for coming here. And anybody watching this wants to go check out the Money Platform. It's themoneyplatform.com. You can go take a look around, sign up for an account if you wish to, and give it a shot, see how it goes. Anything else you want to say before we sign off?
No, that's all, thanks. Thank you very much to everyone for listening, and look forward to staying in touch with you, Lawrence, and with anyone who's watching who wants to stay in touch. You can find me on LinkedIn, and just stay in touch.
Excellent. Okay, George. Well,
Cool.
have a great evening, and I will have you back on in a few months. We'll see how things are going, if that's cool.
Nice. Okay.
Okay.
Thanks,
All right.
Lawrence.
Take care. You're
See you.
welcome.
Bye.
See you. So there you have it. This is George from the Money Platform, CEO. Came up through the ranks. Now is running the company. I think they've got a pretty cool product. I didn't realize they've been going since 2017, so they do have a bit of a track record of coming up to year number 6. And they are providing a service that people need. I mean, obviously the rates that people are paying, interest rates are high, but as that is with short-term lending, it tends to be that way. Just part of the business. You have to decide if that's something you are morally okay with. And just a disclaimer, I do not lend money through the money platform myself, so I cannot speak for the experience, but I know some of you people watching out there do. Anyway, one last announcement is October 6th, we have another guest, which I will show you the website. Ewan Dickey. This is a pretty interesting offering here. Punk Money. This is a kind of a newer company that I learned about from Plend. Hassle-free loans with friends and family. So they do peer-to-peer side lending. Don't know much about them, but I will find out more. And we'll have Ewan Dickey from Punk Money here on October the 6th. So put it in your calendars, everyone, and thank you for joining this evening. I hope you got a lot out of it. I hope you enjoyed it. Have a great weekend as always. I'll look forward to seeing you back here next Thursday for our usual live stream. And subscribe to the channel and hit that thumbs up or the thumbs down, whatever you want. And that's it. We're going to get out of here. So we'll see you next time. Take care. Bye-bye.